At 2:32 p.m. on May 6, 2010, the global financial system simply stopped making sense. There was no terrorist attack. No major bank had collapsed. No disastrous economic report had just been released. The day had been jittery, fueled by protests in Greece, but nothing out of the ordinary. And then, the bottom fell out. On the trading floors of Wall Street and Chicago, veteran brokers stared at their monitors in absolute paralyzing horror. The Dow Jones Industrial Average began to violently plunge. It dropped 300 points, then 600 points. Within a matter of minutes, the index had plummeted nearly 1,000 points, the largest intraday point drop in the history of the market up to that day. Almost $1 trillion in wealth was completely vaporized in the span of a coffee break. Blue-chip powerhouse companies, the untouchable titans of American industry, suddenly traded at impossible valuations. Shares of the consulting firm Accenture, normally trading around $40, were suddenly being executed at exactly 1 penny per share. Other stocks inexplicably skyrocketed, trading at $100,000 a share. The pricing mechanism of the United States economy had completely broken. And then, just 36 minutes later, the market aggressively snapped back. The prices stabilized, the $1 trillion miraculously reappeared on the ledgers, and the bleeding stopped. The financial media panicked, demanding answers. Politicians called emergency hearings. The world assumed it was a cyber attack by a foreign superpower or a catastrophic failure by a massive Wall Street bank. But it wasn't a bank. And it wasn't a superpower. Welcome to Case 016. Today, we open the file on the 2010 flash crash and the bedroom algorithm. We will investigate the terrifying ghost of market liquidity, the predatory rise of high-frequency trading, and how a single-day trader in a suburban bedroom managed to trick the smartest machines on Wall Street and spark a $1 trillion inferno. To understand how the market broke, you first have to understand the man who lit the match. Navinder Singh Sarao was not your typical Wall Street titan. He didn't wear a bespoke pinstripe suit, he didn't work in a glass tower in Manhattan, and he didn't have an Ivy League degree. He operated out of his childhood bedroom in his parents' modest, semi-detached house in Hounslow, a working-class suburb under the flight path of London's Heathrow Airport. He was known in the trading community by a fitting moniker, the Hound of Hounslow. Sarao was a savant. He didn't look at the financial markets as a place to invest in companies. He looked at the market like a massive, multiplayer video game. He possessed a supernatural ability to process chaotic streams of numerical data, identify microscopic patterns, and click a mouse faster than almost anyone alive. Operating entirely on his own, trading futures contracts on the S&P 500, Sarao was pulling in millions of dollars a year in pure profit. He was wildly successful, yet he lived a remarkably frugal life, wearing cheap sweatpants and refusing to buy a luxury car. The money didn't matter to him. The high score mattered. But by 2009, Sarao noticed a terrifying shift in his video game. The market was changing. He was no longer trading against other human beings. He was trading against machines. Wall Street had quietly entered the era of high-frequency trading, or HFT. Massive, multi-billion-dollar hedge funds had built proprietary algorithms and housed their supercomputers right next to the physical exchange servers. These machines were designed to execute thousands of trades in a fraction of a millisecond. These HFT algorithms were predatory. They were programmed to identify a large order placed by a retail investor or a pension fund, race ahead of it, buy the stock first, and then sell it back to the original buyer a millisecond later for a microscopic profit. They were essentially legally front-running the entire market. Sarao despised them. He viewed the HFT algorithms as a parasite, a rigged system designed to slowly bleed human traders dry. He complained to the regulators, but the regulators did nothing. So, Sarao decided that if the regulators wouldn't stop the machines, he would build a weapon to hunt them himself. The high-frequency trading machines operated on a very specific set of rules. They were designed to constantly scan the order book, the digital ledger of all the buy and sell orders waiting to be executed. If the algorithm saw a massive wall of sell orders piling up, they mathematically assumed the price was about to drop. They would instantly cancel their own buy orders and start selling to get ahead of the crash. Sarao realized that the machines were fast, but they were incredibly stupid. They couldn't tell the difference between a real order and a fake one. In 2009, Sarao hired a software developer to build a custom, heavily modified trading program. This software was designed to execute a highly illegal, manipulative tactic known as spoofing. Here is how the weapon worked. Sarao would identify the current price of the S&P 500. He would then use his custom software to rapidly place massive, multi-million-dollar sell orders just a few ticks above the current price. He had absolutely no intention of ever actually executing those trades. They were bait. When the high-frequency trading algorithms scanned the order book and saw Sarao's massive wall of sell orders looming above them, the machines panicked. They assumed a massive institutional seller was entering the market. To protect themselves, the algorithms instantly began dropping their bids, driving the actual price of the market down. As the price dropped, Sarao's software would instantly cancel the fake sell orders before they could be executed, and place a new wall of fake orders even lower. He was essentially using a digital ghost to physically push the market down. Once the HFT algorithms had driven the price low enough, Sarao would flip his position, buy the incredibly cheap contracts, and ride the inevitable bounce back up for a massive, guaranteed profit. He wasn't predicting the market. He was actively herding the Wall Street supercomputers like sheep. And for a while, the strategy made him tens of millions of dollars. But on May 6, 2010, the herd stampeded over a cliff. On the day of the flash crash, the market was already a powder keg. The European debt crisis was dominating the news, and human traders were nervous. Around 2:30 p.m., a massive traditional mutual fund called Waddell & Reed placed a legitimate, massive order to sell $4.1 billion worth of S&P 500 futures contracts to hedge their portfolio. Under normal circumstances, the market could absorb this order over a few hours. But the market was no longer normal. At the exact same time, Navinder Sarao was running his spoofing algorithm from his bedroom in London. His software was aggressively slamming the order book with thousands of fake, massive sell orders, actively pushing the price down to trap the HFT algorithms. The combination was apocalyptic. The high-frequency algorithms looked at the real $4.1 billion sell order, and then they looked at Sarao's massive aggressive wall of fake spoofing orders. The machines concluded that the market was in a state of terminal, catastrophic freefall. And then, the machines did the most terrifying thing a financial system can do. They turned off. High-frequency trading firms are legally classified as market makers. Their job is to provide liquidity, to always be willing to buy or sell a stock to keep the market moving smoothly. But their algorithms were programmed with emergency kill switches. If the volatility became too extreme, the machines were instructed to immediately cancel all their orders, pull their money, and exit the market to protect the firm's capital. Within seconds, the HFT algorithms vanished. The liquidity that Wall Street boasted about was entirely an illusion. It wasn't real money. It was phantom money provided by machines that only stayed in the market when it was safe. With the machines gone, there were suddenly zero buyers left in the market. When you have billions of dollars in sell orders and absolutely zero buyers, the price doesn't just drop. It falls into a black hole. This is what caused Accenture to trade for a single penny. The market had completely fragmented. The machines had abandoned their posts, leaving a trillion-dollar void in their wake. It took exactly 36 minutes for human traders to realize that the fundamental economy had not actually collapsed, and for the algorithms to be rebooted and re-enter the market, buying up the incredibly cheap assets and snapping the prices back to reality. But the damage was permanently done. The trust in the modern, computerized financial system was shattered. It took the government 5 years to figure out what had actually happened. Investigators sifted through terabytes of raw market data, looking for the anomaly. Eventually, they found the digital fingerprints of the spoofing algorithm tracing all the way back to a suburban bedroom in London. In 2015, the FBI and British authorities raided Sarao's home. The man, who had amassed a trading fortune of nearly $40 million, was arrested. He was eventually extradited to the United States, facing decades in federal prison for wire fraud and market manipulation. Sarao did not single-handedly cause the flash crash. The market structure was already dangerously fragile, and the massive Waddell and Reed sell order was the heavy fundamental weight. But Sarao's spoofing algorithm was the spark that ignited the algorithmic panic. He exposed the fatal flaw in Wall Street's multi-billion-dollar supercomputers. The 2010 flash crash is the ultimate modern parable about the illusion of safety in a digitized world. In the modern market, you are not trading against a human being on the floor of the New York Stock Exchange. You are swimming in a dark pool dominated by predatory, hyper-fast algorithms. The liquidity that you see on your trading screen is often a ghost. When the market is calm, the machines are there, picking up pennies in front of a steamroller. But the moment true panic sets in, the machines will ruthlessly unplug themselves to survive, and the floor will vanish beneath your feet. For the modern strategist, the lesson is clear. Do not attempt to play the high-frequency game. If you try to day trade the microscopic movements of the market, you are bringing a knife to a drone fight. The machines will front-run your orders, they will spoof your stops, and they will bleed your capital dry 1 millisecond at a time. Your only true defense against the algorithmic warfare of Wall Street is to extend your time horizon. The algorithms can control the next 5 seconds, and they can manipulate the next 5 minutes. But they cannot manipulate the fundamental value of a great asset over the next 5 years. To beat the machines, you have to refuse to play their game entirely. This closes Case File 016.